requirements for SMEs. Under the financial reporting, we are also going to look at some sample financial statements that you can prepare by yourself without needing an assistance. Okay. We're going to start with the definition of tax. I'm sure all of us, one way or the other, we've heard of it. A tax normally is a compulsory levy by the government of a country to maybe a business or an individual to be able to carry out activities on behalf of those persons. It's true that normally, in most cases, the person who pays the tax does not see the direct benefit to them because the taxes collected can be used maybe for building roads, hospitals, providing public utilities like public lighting. Because normally the street lights that we see, we actually don't pay for them, the state does. So we are going to move on to the next definition, which is a tax bearer. This is actually the person who bears the burden of the tax, who is different from the person who pays the tax. So the taxpayer is either an institution or an individual person. Let's take an example. You go into a supermarket like SuperU and you buy an item which is liable to VAT. You are the tax bearer because you pay the item plus the VAT on it. SuperU does not pay the VAT. SuperU just transfers that VAT to the state on your behalf. So in that case, SuperU is a taxpayer and you are the tax bearer. So that's just the difference. The next definition we'll look at is tax evasion. This is actually an illegal means that someone or an entity can use to reduce their tax burden. So this can be perpetuated by either manipulating the figures in the company's accounts or not declaring everything. So this is actually illegal and it's penalized by law. We move, excuse me. The next definition is tax avoidance or tax planning, which in this case is actually legal. It is a legal means where you can actually exploit the loopholes in the tax system of the country and be able to take advantage of those loopholes legally. So I think there's normally a confusion between tax evasion and tax avoidance. Tax avoidance is actually legal and evasion is illegal. And then we move on to what a tax base is, or a tax assessment base. This is summarily the amount on which a tax rate is applied. For example, in a company, a tax rate could be applied to your profits. That profit is called the tax base. If you own land, the value of the landed property on which the land tax is applied is called the tax base. And then we move on to tax returns. These are just the forms that taxpayers use to be able to declare and pay their taxes to the administration. And we have what we call a tax deduction, which is an amount that can be deducted from income or profits in order to obtain the final amount on the profit that is subject to tax. And we can have some items that are exempted from tax, so we call them tax exempt. But items that are tax exempt, that they are not taxable, you exclude them before you tax the balance. So could you please put pluses in the chat if you can get me to hear? Let me know if we're following or not. Okay, thank you very much. So the next thing we are going to be looking at is the tax assessment system that we have in Cameroon. So we have basically 3 tax assessment systems in Cameroon. We have the flat rate system, the simplified tax system, and the actual earnings tax system. We are going to discuss each of them in detail. So we start with the global tax system, which is applicable to natural persons or sole proprietors with a turnover less than 10 million. When we talk of turnover, we don't mean your profit for your business. We mean everything that you've sold, sales. Turnover is your sales, what you've sold. It's not your profit. So the sales of the business that are less, if you have a business where the sales are less than 10 million, this 10 million is annually, it's not monthly. 10 million for the whole year, and you are engaged in any commercial, industrial, or agro-pastoral activity, then which does not fall either under the simplified or actual earnings, then you will fall under the global tax system. Now we have some exceptions of business activities that could fall under this global tax, which have turnover that's less than 10 million. So we can have IT companies, forestry exploiters or logging companies, liberal professions like pharmacies, lawyers, doctors. These professions actually have additional requirements, and they are not assessed based on their turnover, but on they're assessed based on their turnover, but then the nature of their activity is taken into consideration. So we move on to look at how the global tax is actually paid. It is paid quarterly, and you can pay all at once if you choose to. Normally, everyone that is under the global tax system, business persons who are liable to the global tax system, are categorized into 4 based on the turnover. So we have categories A, categories B, category C, and category D. So for tax payers in category A, they are those whose annual turnover is between 0 to 2.5 million. So if your business has annual revenue of 0 to 2.5 million, you're going to pay the global tax between 0 and 20,000 francs. The exact amount to be paid is determined by the tax center or your local council where you go to, so they'll do an assessment for you. That's why the tax code gives a range instead of an exact amount, because the circumstances could be different. So those in category D are those with annual turnover between 2.5 and 5 million. So your global tax is between 21,000 and 40,000. Those in category C, we have 5 million to 7.5 million, which is the global tax is between 41,000 and 50,000. And then those in category D are those with turnover between 7.5 million and 10 million. And their global tax ranges from 51,000 to 100,000. So normally, apart from paying your global tax, which as I earlier said, could either be paid quarterly every quarter, but it's not really advisable because every quarter you could every quarter they have to do a reassessment again. And at the end of the year, you might get to pay more. So it's advisable that you pay annually. So apart from paying the global tax, if you're in the global tax system, you'll be required to pay the local development tax. Normally, according to collective convention, we have and also the general tax code. There's a local development tax scale that has already been established. So you pay per the scale. There's a scale, so nobody's going to tell you to pay local development tax that you're not liable to. By a scale, I mean a standard table that is established that you can pay according to the range where you fall. Just as we have category A, 0 to 2.5 million is this. And then you're also going to be liable to pay rent registration. So the rents could either be verbal or you bring your lease registration. By verbal rent, you mean you don't actually have a rent contract where you do your business and the business premises is not yours. So you normally go and tell, maybe you don't have a rental agreement with your landlord. So you normally go and declare verbally to the taxation people that I don't have a rent agreement, but this is the amount of rent that I pay every month to my landlord. So in that case, it's called verbal rent. So from the verbal rent that you've declared, they're going to calculate 10% of that annual rent, because I think you're going to say maybe I pay 25,000 francs per month. So they're going to take 25,000 francs times 12 months and then 10% of 12 months. That is what you're going to pay as your rent registration. So if you have a lease agreement with your landlord, you will normally bring the lease agreement and the amount of the rent is on the agreement. So they'll just pick the amount from the agreement and do the calculations and then you pay. If you are actually operating in your own premises, like you own a piece of land and you choose to use maybe part of your building to do your own business, you will have to show proof of land tax. Have to show that, okay, you've paid land tax for this property. That way you will not be liable to the rent registration. Normally, when you pay your global tax, the tax officials are supposed to issue you a ticket that's a proof of payment. And you have to display this ticket in your business premises where anybody entering can actually see. If you don't display this, you can be penalized. So normally, if you do not display it, it's 5,000 francs, but it could be more because some other issues might come in. So if you have paid your global tax, it doesn't cost you anything. Even if you don't have a pin, use gum, even chewing gum or tape, paste it on your wall. The receipt, they might give you 2 receipts, paste them on your wall. Keep the original, make the photocopy and paste them inside the wall of your business premises. It's not supposed to be outside because dust and rain, all those things can wash it off. So if you've paid, please do paste it up. And if you've not paid, you also be liable to taxes when tax people come for the tax controls. So most of the time we see business people being resistant to put up their proof of payment. I don't know, maybe because they don't know. And when a tax person tells you that, okay, if you have paid, put it up, because if you have it inside your purse, it's not up, I can still fine you for it. People start arguing, but that is what the law says. They are simply following the law. Okay, so normally it is possible that you are in the group under the global tax system, but then if your business is assessed to be earning revenue, annual revenue that's more than 10 million, then you will be liable to taxes that fall in the range of your revenue. What I mean is, if initially you started your small business, your small business, and maybe your turnover was 7.5 per year, and you've grown big over the years, and your turnover now is 20 million. You are not going to pay your taxes based, that's the global tax, but you're going to pay business license. So you are still going to be under the global tax system, but then the percentages of your payments are going to change. You're not going to still be categorized as maybe category A, B, and C. If you registered a business, maybe your business name was Mr. Electronics. You don't have to go and change it into Mr. Electronic private limited company or public limited company. No, it's still going to be Mr. If you don't want to change the name, it's fine. If you want to change the name, okay. But if you don't want to change the name, it's still going to be Mr. Electronics. But then you're going to pay taxes either under the simplified regime or the actual regime, depending on your current turnover. Sorry, before we continue, it skipped my mind at the start of the class. If you have any questions, please jot them down. In the last 30 minutes of the class, you will have the opportunity to ask all your questions. The next tax system is the simplified regime. Here, those who are liable are those with annual turnover between 10 million and 50 million. We talk of natural persons or artificial persons. A natural person is somebody like you and I. I can see you, I can touch you. You breathe, I breathe. But then the artificial person is like a company. You know that a company exists, but you cannot physically touch it. So that's an artificial person. So those with turnover between 10 million and 50 million, they're assessed under this regime, except for passenger transporters and operators of games of chance and entertainment. Because passenger transporters, they have extra conditions. And also those with games of chance, they also have different conditions attached to their operations. If you own a game house, maybe your business is just a game house, your taxes are going to be different from somebody who owns a normal business, maybe a shop or yes, a normal shop. Because for the game house, you're going to pay tax licenses for the games that you have. Maybe it's baby food or other games. You're going to pay license for that game, and you're going to pay tax on the income from that game, the games, sorry. So if you own a business that has a section of a game house, you're going to pay licenses twice, because your game house has, it's like a separate segment. So you pay in taxes on the income from the games and also license for the machines. And then you now pay your normal license for your business. But what we normally have locally that operates is we might have a grill launch that has maybe a table for baby food. You don't have to pay that extra. It is just you cannot really be considered as a game center. It is just one. You might be expected to pay something extra, but not much for that. So for taxpayers who are liable to, who are under the simplified taxation system, normally they are supposed to pay taxes such as monthly payroll taxes, depending on the number of employees they have. Because normally if you have employees, you're supposed to register them at the CNPS and also pay the taxes. That's the taxes for CNPS. We have the taxes that are paid by the supplier and, by the employer, and those that are paid by the employees. But both are collected by the employer and paid at the CNPS. So there are some that are deducted from the employee's payroll and others that are borne by the employer. So the employee does not leave and say, okay, this is what I'm taking to go and pay to CNPS. And the employer says, okay, this is my own share, I'm going to pay the CNPS. No, the employer deducts from the employee at source. And now plus the part that he is liable to, and declares them on a monthly basis at CNPS. You do that online, and then you do the payments every month. Under the simplified regime, you're also required to pay a monthly advance company tax, which is 5.5% of the turnover of your previous month. We are in November. That means the advance company tax that you're going to declare this month before the 15th will be 5.5% of the turnover you made for the month of October. And then you also be required to pay the company tax. This is done at the end of the year. Normally the advance can be considered as part of the company tax, but the bases are different. So the company tax is at the end of the year when you do your statistics and tax return, which takes into consideration the advance company tax that you've paid monthly for the whole year. So if at the end of the year, the amount of tax that you've paid monthly is the same as what you're supposed to pay throughout the year. You have nothing extra to pay. If what you're supposed to pay throughout the year is more than what you have paid monthly, it means that you have an extra amount of tax to pay to the taxation officials. But if what you have paid monthly is more than what you were supposed to pay annually, then the taxation owes you. But you cannot go to taxation and say you owe me, give me a refund of the tax that I have overpaid. No, you carry it forward and offset it with the tax of the upcoming periods. Taxation officials do not refund tax to you. You carry it forward. That means, for example, if you have the specificities that goes into the offsetting, but I'll give a general example for us to better understand. If at the end of December 2020 that just passed, you overpaid your tax by 10,000. When doing your declarations for January, there's a column where you have tax that you overpaid. In your declarations, there's a space for that. So you put, and then the net. So I don't know if you understand that there will be now a net of what you're supposed to pay now and what you've already paid. Or if you don't want to offset it there, you can offset it at the end of the year. So it really depends on you. But there's provision for that in your tax return and your monthly tax declaration. So if you're under the simplified regime, you're also to pay the business license, which is annually, and you have to pay it before the 28th of February every year. After the 28th of February, you're going to be penalized for late payment. And you also have to pay the rent, which could be verbal or through your lease registration. And now for the simplified regime, there's an additional rent, the advance on rent, PSL in French, précompte sur loyer. It's 15%. Normally, this is borne by your landlord, but then the business has to pay it and then ask for refund from the landlord, because you're going to go to the landlord and ask them to come and pay. In Cameroon, it's not going to work like that. You are going to just turn around, and it's still not going to happen, and it's going to waste time in your registration. So the best thing, what is advisable, is that you pay your 10% plus the 15%, and then you request for a refund from your landlord. And we also have to know that where you pay your tax, for if you're in a global tax system, the simplified, your regime determines where you pay your tax, like the location. For the global tax, you can pay your tax at the council in your locality, or a tax center. If you don't have a council, you can have a tax center. So you can pay your taxes there, but then no matter which regime, it has to be done online. And also for the simplified regime, you pay your taxes at divisional tax centers. There are divisional tax centers in, the number of divisional tax centers depends on the number of taxpayers that are in that location. For example, in Douala, we have so many. You can have in Douala 1, Douala 3, you can have so many divisional tax centers. You have there's Douala 1, Douala 2, Douala 3, Douala 4, Douala 5. So the number depends on the number of taxpayers there to ease their work, so that people don't have to go very far to be able to pay taxes. And also the 2021, we have it's an advantage in the tax rates that was given to small and medium-sized enterprises. So the tax rate for small and medium-sized enterprises was reduced to 28%, which was previously 30%. For companies with turnover that is less than or equal to 3 billion. But if your turnover is above 3 billion, your tax rate is maintained at 30% plus a 10% additional council tax. We move to the last regime, which is the actual earnings regime. Here we're talking about companies with turnover that ranges between 50 million to 3 billion and above. And also they are required to file every tax that is filed under the simplified regime. But then there are a few differences and additional requirements. For example, if you are under the actual regime, you are permitted to charge VAT and also do VAT declarations monthly. But you cannot do this if you're in the simplified regime. You just collect the VAT and pay. You don't charge VAT on your invoices if you're under the simplified regime, but then you pay VAT. This means, for example, if you buy something from a supplier and he inputs VAT on the invoice, you have to pay it if you're in the simplified regime, but you cannot put VAT on your own invoice. So it does not forbid you from paying VAT, it forbids you from charging the VAT. If you are under the actual regime, then you're allowed to charge the VAT, and then you have to do monthly declarations for that as well. The advanced company tax in this case is 2.2% instead of 5.5%. So there's an advantage in this case. And then for those in the actual regime, they pay their taxes at the medium taxpayers office, medium-sized taxpayers office, call it MTO, at the scene in French. And the declarations are also done online. Okay. Can we hear me? Are we following up to this time? And please don't hesitate.
Following.
Okay, don't hesitate to let me know if I'm too fast, because sometimes I could be too fast. Okay, thank you very much. We're going to move on to the business registration process in Cameroon. So normally to register your business in Cameroon, you have to decide with if you have partners, you have to decide on the form of the business that you want to register. Whether you want it to be a sole proprietorship if you're alone, to be a partnership if you have friends you want to join, you want to do business together, or a private limited company. So first you have to decide on the form of business that you want, because normally for each of these forms, the registration requirements differ a bit, not largely, but a bit. The requirements that you expected to bring at the registration center are different. So for normally to register your business completely in Cameroon, you have to go through 3 phases. I can say phases or stages. So we start with registration at the Center for Business Creation, which is in French is CFCE. Normally, CFCE has a center in each region. So each region has at least one center where you can go there and you register your business. Now, the requirements will depend on the nature of your business, the form that you've chosen. So for a sole proprietor, that's you're a physical person, you will be requested to fill a form at the center. You will request to bring 2 copies of your birth certificate or any other identifying documents, a copy of your marriage certificate, if it's applicable, a certificate of non-conviction, a location plan that is signed by you. Because now we don't require that you go and do a certified location plan at the taxation office. No, that was, as a communique issued in May 2021 this year, the location plan that clearly describes where your business is, location and everything, and is signed by you is okay. You don't need to go and stamp it. And also an authorization to do business if that's required. So normally you'll be required to pay a tariff of 41,500. So it's broken down into 21,500 for registration, and also for registration, sorry, in the commerce register, and 20,000 francs for registration fee. Please note that this tariff does not include stamp duty because there might be documents that you need to stamp. This tariff does not include stamp duty, and it does not include a legal fee or middleman fee if you need to use a middleman or a lawyer. It does not include. These are the exact taxes you're supposed to pay to the administration, excluding any external person that you're needing your assistance, and also stamp duty and photocopy and all that. It's excluded. So you also need to give a complete address of your business. So if you are going to register as a moral person, that's a business in form of a company, your requirements are a bit more than that of somebody who's registering as a sole proprietorship. So you still need to fill a form at CFCO. You need to bring your articles of association or your company bylaws if you're a partnership. And these have to be stamped, each of them. And normally for fiscal stamp, the fiscal stamp now is per page, it's not per document. So if your document has 5 pages, you have to affix a fiscal stamp of 1,000 francs on each of those pages. So if you're required to come with 5 copies of your documents, that means you're going to affix 5 fiscal stamps on 5 copies. That's 5 times 5. Please take note. And you also need to provide a notarized statement of subscription and payment of shares. By notarized statement, we mean a statement from your notary that clearly states that these shares have been subscribed and paid by the shareholders. We have to bring it in 5 copies. You have to provide that in 5 copies. So this is a document that's prepared by your notary. Your notary, you could also, depending on negotiations with your notary, you also let them prepare the articles of association for you, the notarized statement of subscription of shares, the certificate of appointment of managers. This is also prepared by your notary. And then certificate of non-conviction of each of the shareholders or associates. This one is gotten from this is you who does it, not your notary. And then we have photocopies of the ID cards or birth certificates of all your business associates. We have a photocopy of ID card for each manager. So because you can have your company where you form it, but then the managers are not part of the shareholders. So in this case, it's different. Your shareholders will have to bring their identification document, and the managers will also have to bring the identification document. But if some of your shareholders are at the same time the managers, then once is fine because it's the same person. And then you have to bring a location plan for your business and authorization to do business if that's applicable, and then a tariff. Now the 54,625 is broken down into 21,500 francs for registration in the Commerce Register, 20,000 francs registration fee, and 13,000 francs for publication in the Official Gazette. Official Gazette, we mean a newspaper that is nationally recognized, because when you create a company, you have to publicize it for everyone to know that you have created a company. So this fee is for publication in a national newspaper, not the local one that nobody knows, a national one. So anybody from anywhere can read and know. And then you also have to provide an address for your company. If you don't yet have a PO box, it's fine, but at least a telephone number or an email address, even if it's your personal email address, you'll still be fine. Following after registration with the CFCO, you're going to be provided with your taxpayer card, which is now called the attestation of taxpayers registration, and your commerce register number and a commerce register page and other documents. So from there, you have to go to the next stage is for you to go to taxation with those documents. And at the taxation, normally, when companies, what we generally have that happens is that when persons register their business at CFCO and they already have their taxpayer identification number, they believe that everything is fine. And that maybe when they start doing big business, they'll now go and start registering their taxes and all that. But that is not the case. Immediately you finish from CFCU, you have to go to taxation within the first 15 days. And with the correspondence, you have to, if you have started your business officially, that you're already in business operating fully, you have to declare at taxation that you have started a business. You have to register with taxation, because it is at taxation where you pay your rent registration, your business license. So you have to go to taxation with your documents from CFCU and register your business at taxation as soon as possible. If you delay, there is going to be penalties. But I think that most people, they ignore it. Either they don't know or they're just stubborn. The penalties can actually really discourage you. You might feel like closing your business. So these are little steps that really don't cost much. If you have not yet started your business fully, you see you're still planning to do it, but you wanted to do a registration first, maybe you needed a registration number for something, but then you have not yet set up and started operating fully, it is still fine. You write a letter, normal letter that you write to the taxation office, you address it to the chief of center of your locality. You explain in the letter that you've created a business, it's called this. The registration number is this. The business was formed in this month, on this day, it depends on you. But then it has not yet gone fully operational. So you are just writing to notify them that a business has been created, and that when you go fully operational, you're going to come back and formalize everything. This simple letter that you write, that's not going to cost you up to 100 francs. And with a stamp of 1,000 francs, that's everything to do. Is not up to 2,000 francs to deposit at taxation. But there are people who ignore it and they have to go and pay thousands and even millions afterwards. But it's a simple process that we can follow. It's very easy, it's not difficult. So sometimes we are the ones who intentionally put ourselves into trouble. This is not difficult. So if you've created your business, write a simple, and you've not started fully, write a simple letter to formalize that you've created. But then when you finish setting up everything, you come back. So when you deposit this letter, ensure you have a discharged copy, because when you deposit a document at taxation, they normally stamp it, that's acknowledgement of receipt with a particular number. So ensure that you keep your own copy jealously, scan it and save it in your email. Because when you go for formalization, after you have set up everything, they will need that copy, because you know that it's very difficult for the taxation officers to go and start searching in their physical files to find your documents. So if you go with that discharge, it makes the job very easy. They continue from there. But if you go without it, I can say you are at base, because they might not be able to help you, because you're asking somebody to go, even if you were the one sitting in that office, I don't think that you would do it. You're asking someone to go into an archive of thousands. Let's say you started operations effectively 1 year after. You're expecting him to go into an archive of 1 year after, which is not just for you, but thousands of taxpayers, to go and search each and every one of them. So it's very discouraging. So please keep the discharged copy very well. On the day that you're ready and want to formalize everything, go with a copy of the discharge. They'll continue from there, and then they'll be able to build up your file. From there, you can ask how to proceed and how to proceed, and they'll give you various steps and maybe other documents to bring, like other registration documents that you can bring as copies, so that you'll be able to set up your file. So, but if you have fully started business, so you just need to go to taxation and register, and then after registration, I don't know who brought up the idea that when you register a business and you register with taxation, you have to stay some months before you start declaring. It's not true. You have to start declaring. Okay, so the next step is registration with the National Social Insurance Fund. So when you're finished with taxation, you can do taxation and NSIF at the same time. You don't need to finish one to go to the next one. Because normally when you register your business at taxation, in the system, it goes straight to CNPS. So CNPS can see when you register it at taxation. So if you register at taxation and you stay for 1 year and they go and test everything, no, I am just registering this business now. They can see when you started. So sometimes we don't know that you can see. Or if you register, there's a flow of the transaction. Once you register taxation, it flows straight into their system. But then you have to come and call it like activate, if you can permit me to use that word. So normally, if you have not started operations fully, it is the same process with NCIV. Write a letter to them explaining that you've created a business, but you have not started fully. So you write a letter, they also give you a discharge copy. You also keep it. So when you're ready, you come with the copy and do everything that they're supposed to do to set you up so that you can go and continue your business. But if you have actually started operations, but you have not yet employed a staff, because it's different from you not starting operations at all. If you have started operations, but you have not yet employed a staff, you're still looking for a staff, maybe it's a one-man business and you are the only person struggling with it, or maybe it's a business with friends and you're all shareholders. So just the manager is still struggling to run things by himself. You don't yet have a staff. You will have to declare that as well. And then they will give you an attestation of non-employment of salaried staff. That they'll issue a document, you pay for it, it's less than 3,000 francs. You go and pay at the bank, and then you bring them the receipts. They'll give you they provide you with the bank account. But normally, what they normally do is they just direct it to the bank, I think CBC, another bank, they have the account number for CNPS pasted on your wall. So even if you go and ask, we'll just show you the account number. So you just fill it on the form. So you pay at the bank and then you bring back the receipt at CNPS. They're going to issue to you an attestation of non-employment of salaried staff to show that you've started business, but then you don't yet have salaried staff. So this attestation is valid for 3 months. After 3 months, if you still don't have staff, you can go and renew it for the same period. All right, so when you are through with the entire registration process, for us to confirm that you have, for you also to be comfortable with yourself, you have finished your registration process, you will have a certificate of company registration. This is from CFCU. An attestation of business creation. This is from CFCU. A taxpayer's card. This is from CFCU. A business license or global tax. That's proof of it from taxation. Articles and memorandum of association. These ones were registered as CFCU at the incorporation. And then certificate of appointment of managers, also assigned by your notary. So I would like us to take a moment to look at the business license and how it is calculated or assessed before you pay for it. Normally, the business license is paid according to your turnover. If you are in the flat or global tax system, you pay the global rate for your category, either A, B, or C, as we previously mentioned, so you don't have to pay business license unless your turnover has gone above 10 million. So if you are in the simplified tax system, your business license is calculated as 0.494% of the previous year's turnover. So you have a minimum contribution of 50,000 francs and a maximum of 140,000 francs. Let me try to explain. You can get more details on this under section C13 sub 1 of the General Tax Code if you have a copy. When we say minimum, it means that if 0.494% of your previous year's turnover is less than 50,000, you are going to pay 50,000. If it is between 50,000 and 140,000, you pay the exact amount, not 50,000. But if it is above 140,000 francs, you pay just 140,000 francs. That's what it means. So if you are in the actual earnings regime, there are two rates that are applicable depending on your turnover. So we have 0.283% of the previous year's turnover if your turnover is between 50 million and 3 billion. So you pay a minimum of 141,500 and a maximum of 4.5 million. We have 0.159% if your previous year's turnover is above 3 billion. So you pay a minimum of 5 million and a maximum of 2.5 billion. Okay, I hope we're following up to here. Excuse me. Okay, thank you very much. Give me a moment. Sorry, I have a slight bug. Anyway, while the machine is doing its work, let's continue before I'll be able to show you the slides. Okay. Financial reporting requirement. We're going to be looking at financial reporting requirements for SMEs in Cameroon. So normally for the financial reporting requirements, all companies, either except for public accounting, companies that are regulated, that's regulated by public accounting, all commercial enterprises governed by commercial law, public and para-public enterprises with mixed and private ownership interests, cooperatives, general, in fact, all entities that produce goods and services, whether for sale or not, for profit making or not, you're required to prepare your accounting books, or that's financial reporting, according to the accounting plan. The OHADA accounting plan, sorry, besides that. Okay, give me a moment to project. Can you see my screen?
Yes.
Okay. Thank you. So as I was saying, for the financial reporting requirements for SMEs, whether you are profit making or not, a cooperative or not, you're required, as long as you're in the OHADA region, to prepare your financial reports according to the provisions of the OHADA accounting plan. So normally, I know that we've all heard of accounting, maybe all of us or some of us, of the OHADA, but then we're not going to dig into the history of the OHADA. We're just going to give a brief. Normally, the OHADA is an international organization that was created by a treaty that was signed in 1993 at Mauritius by 14 African countries. There are currently, for 2019 statistics, there are 17 countries made up of Cameroon, Burkina Faso, Republic of Central Africa, Ivory Coast, Gabon, Guinea-Bissau, Equatorial Guinea, Mali, Niger, Chad, Togo, Senegal, Guinea, Comoros, Congo, and the Democratic Republic of Congo. So normally the OHADA is made up of two components. It could have many other things, but these are summarized into two. So we have the Uniform Accounting Law, which lays down a harmonized accounting system for companies located in the member states. That's these 17 countries. And then we have the second component, which is the component, which is the OHADA accounting system, which deals with the structure and functioning of accounts and the nature, format, and content of financial statements to be prepared and presented to users. So normally the aim of this structure is to ensure that there's reliability, there's clarity, and there's comparability of financial information, both inside the company, that's within the company, and also for information that's provided to those out of the company, that outside stakeholder, that's to the public. So concerning the financial statements for countries in the OHADA region, there are 3 tiers of accounting obligation. When we say tiers, we mean 3 structures or 3 layouts that the OHADA provides to companies based on their size. So we start with the normal or ordinary accounting system. This is for larger companies with turnover that exceeds 50 million. So if you run a company that with turnover that exceeds 50 million, you're expected to prepare as your annual financial statements a balance sheet showing your assets, your liabilities. Assets, that's what you own, and liabilities, what you owe, and also your equity. And then we have a statement of profit and loss, cash flow statements, and then accounting policies. The accounting policies are simply a document. You can prepare it in Word. It doesn't disturb. It's just for you to say which accounting policies are applicable in your company in the current financial year for which you are preparing the financial statements. So you could include accounting policies like going concern, what it is to you, accrual basis, if you prepare your financial statements either based on accrual basis or cash basis. And then you also define your year end, when your year starts and when your year ends, because normally fiscally the fiscal year ends on the 31st of December. That starts on 1st of January and ends on the 31st of December. But then your company could have started in the middle of the year. So you're not required to say that you started on the 1st of December. So you have to include this in your accounting policies where you have maybe a heading of financial year. So if you started your business in the second quarter of the second semester of the year, you're allowed to prepare your financial statements after 18 months. So that is actually allowed. You can do that. You're also required to provide explanatory notes to the account that provide additional information. By explanatory notes, we mean further details on items that are in the financial statements. Maybe you have an assets line item that you want to throw more light on. So you put a note, you can put a number inside the financial statement body. And you come at the bottom of the financial statement, you say note 2, give the explanation that you want to give so that somebody can better understand what is inside that item. It's notes are required for significant items and also some items that might not be significant in amount, but the nature is significant. Maybe something happened. So you're not required to put a note for each item on your financial statement, but at least for something that's significant that requires others to know about it as the financial statement users. So you're required to disclose that. So normally the normal accounting system applies for all companies except for small size companies that use maybe the simplified system or the cash-based system. So the next is the simplified accounting system. If your business is operating with turnover not exceeding 50 million, you can choose to Prepare your financial statements under the simplified accounting system layout, where you're required to prepare a balance sheet, the statement of profit and loss, accounting policies, and also explanatory notes. So these explanation notes, accounting policies, they give the same information, but then it's the format of the financial statement that actually differs. So the last is the minimum treasury system, also called the minimum cash-based system, which is normally for very small companies, not very small, but if your turnover is less than 10 million, yes, you're allowed to use this. Also, if you're a commercial enterprise and your turnover is less than 30 million, you're allowed to use it. If you're an artisanal and related enterprise, your turnover is less than 20 million, yes, you're also allowed to use this system. So under this system, you're just required to do a statement that summarizes your income and expenses for the financial year and also showing a net profit. So you also do a balance sheet, but a very summarized one. So normally for the last paragraph here, financial statements are to be prepared in accordance with models set out in the Uniform Act, except in the case of banks and other financial establishments and insurance companies, which are subject to specific accounting models. Here we are saying that normally your financial statements are supposed to be prepared for the layout that are included in the OHADA, either the normal layout, the simplified, or the minimal. But then there's an exception for banks, financial institutions like banks and insurance companies, because they have specific accounting layouts and models that are specific to the nature of their business. So they are not required to follow these. For example, banks, they might follow some other COBAG regulations and presentations. And for insurance companies, they might follow CIMA. So it depends. So there's exception for banks and insurance companies. So now we are going to look at the final part of our presentation, some samples of financial statements that we can have. These samples are for small businesses. I used a sample for the minimum cash system because I assumed that we all own a business which is small or medium. If we don't have one now, we intend to have a business, and we cannot just start a business from the middle or up. We have to start from the base and go up. So here we have some formats of financial statements that you can keep in your business, and that will not really be a hassle for you. It will really be easy. So we start with a cash book. You can do this in an Excel sheet if you have a computer, or you can draw this out in a ledger. If you do not have a computer, you can draw it in a physical ledger. So here you need to just put the name of your business at the top, just for anybody reading it to be able to see your identification number. This is your taxpayer number. You have the period that is covered by your cash journal. And then you have the duration, whether it is for 2 months, 1 month, 3 months, 12 months, just indicate the duration for better information. So if you do it monthly, because normally it's expected that you work on this, your daily journal. So you do it, if you are doing it in an Excel sheet, for example, you can put this in an Excel sheet and you record your transactions from the 1st of, this is November, the 1st of November, you have a balance that's brought forward from 31st of October. So you do it till the 30th of November, and then you move to the next tab on your Excel sheet where you do it for the next month. Or you can skip a line and do another heading where you continue for the next month instead of putting it all in one table. So that if somebody asks you for your monthly cash book for your past 3 months, you're not going to go and start separating them. You just go and print them out and give them. So normally you have the month of the cash book and also the year. Now you have the date of the transaction, the description of the transaction, what it is you bought or funds you received. So receipts will be funds that you received. Maybe you sold something and your customer paid you. And expenses are things that you spent on, maybe electricity bill, you bought portable water for the office, you paid for water. So just like things that you spend money on. And then you have a balance. This receipts, expenses, and balance, they are a summary of what is to the right. So what I mean is where you have details of receipts, you have sales and others. So where you have, for example, if we say, what I'm trying to explain is that the details, where you have sales and others, others is other things that bring you income, maybe not sales. You could have had a gift as a charity, I don't know, a donation, or free something from somebody. So you also put it, it's a receipt. So it is these two columns that you will sum and put under receipts. So these receipts and expenses, this 1, 2, 3, this third and fourth columns are supposed to be summations, not individual items. So you have to sum all the receipts that you have and you put under receipts. The same goes for expenses. So you might have bought materials and equipment, you might have bought goods, you might have bought other things, you might have paid rents, paid salaries, paid taxes, or any other expenditure. So you put each amount that you spend for each of these items under their columns here. If you have an item that you've spent on, but it does not fall under any of these, you can always add the columns. You're not forbidden. It's a normal sheet. You can add the columns that are missing. Or you might have a situation where you are the owner, you withdraw from the business, you add a column for owner's drawings. You included there. Everything about your business has to be recorded. So at the end, you sum all the expenses, you include them on the line expenses. That means if somebody opens your cash book, your sum of receipts should be the sum of what is under details of receipts, sales, and others. What is under expenses should be the sum of materials and equipment, purchase of goods, other purchases, rents, salaries, taxes, others, and any other item that you've included under expenses. And then now you do the difference between your receipts and your expenses to have your balance at the end of each day. So if it was, this is, let's take for an example, on the 1st of November 2021, your balance that was brought forward from 31st of October was 20,000 francs. So on this table, you are going to put it where we have balance. If you are preparing this in an Excel sheet, I do not expect to see you putting 20,000 there without me knowing where it is coming from. Put a formula, say equal to. You go to the sheet for October and you pick the amount and you press enter, and so we see a link that goes there. But then if you're writing maybe on a piece of paper that's in a ledger, then you can put the amount. But if it's an Excel sheet, at least we see a formula where it's coming from. We don't just paste figures, especially when there are balances. They should be coming from somewhere. And then let's say on the 7th of November, you bought a stapler for your office. You're going to go down to the next line, you put the date, 7th of November, you put a description, purchase of office stationery. You go to the column where you have materials and equipment. You put the amount, maybe you bought a stapler for 2,500 or 5,000. You put there 5,000. And if on the same day you bought water, drinking water for the office, you go to the next line. You don't combine it on the same line. Go to the next line and you say purchase of water, but the same date, purchase of water. So what I'm trying to avoid, what I'm trying to precise here is that avoid putting on the same line purchase a stapler, comma, water, comma, shoe brush, comma, toilet bucket, comma. You understand? Avoid accumulating those things. They have different amounts. First of all, they have different supporting documents if you had the supporting documents. So if somebody comes to control your books and sees so many items, and then maybe you come to the column for reference of supporting documents, you put just one invoice number. And then we go to the invoice, we are seeing just purchase of a bucket. Now, what happens to the other documents? So it is very important that you itemize. You have enough space. Just use the space to itemize whatever it is that you bought. Yes, it's true that if the things that you bought, maybe they have the same receipt, the same invoice or something, yes, you can do it like that. Maybe purchase, you bought the bucket, broom or something like that from the same place, and they give you one receipt for it, it's okay. You put purchase a bucket, broom, and everything for that one receipt, and then you put the amount. That one is okay. And then you go to the end, you put the supplier name, and you put the reference of the document. It makes it easier for control. And it is very important. When we have small businesses, we really neglect invoices and keeping supporting documents. It is a bad habit that we all have to work on. You have to keep these documents. If you buy something from a Kinkellery, they're going to give you a receipt if you ask for it. But if you don't ask for it, they will not give. Yes, there are places where you buy. I don't expect you to go to a shop around your business and buy maybe 1.5 liters of Tangi for 250 and ask for a receipt. That is an exception. I don't expect a receipt for that one. But at least for really small businesses, for items that are really bigger, from 5,000, get a receipt. Unless maybe it's extremely difficult. Sometimes we neglect it. But then it's important, if you come for, it's important for your track records. We get even the receipt, even to keep it is another problem that we also ignore. Getting the receipt is one problem. Keeping the receipt is something that we also ignore. It's not difficult. When you get the receipt, just take a picture of it. Have a file in your office, a physical file, where you've bought, maybe you have files for 100 francs or something. Write a name on it. Maybe purchase of office stationaries, that's a file. You put the receipts for office stationaries there. But then given that these things can always get destroyed, maybe by water, fire, each receipt that you get, take a picture of it or scan it. We have free scanning apps on Play Store. It depends on the phone you use. We have Cam Scanner. It scans for free and it scans into image, even in PDF. So you can scan these documents, put the right name and the invoice number so that it will help you to be able to find it in the future. You scan it and you send it to your email. You create a small folder in your email address where you put just your business supporting documents there. It's going to be very helpful. When you grow big, because I don't believe that any business wants to stay small. These are small habits that when we grow, we are going to operate with them seamlessly. And when we start growing and we have, we need reports. Somebody wants to invest in your business and needs to track records. They need, okay, they need your account that somebody has already reviewed, maybe controlled by a financial controller or audited by an auditor. Auditor comes and you give them your the accounts that you've kept. Normally, you need to provide them with these supporting documents so that they'll verify to see that whatever it is you've put in your account are true for the supporting documents. But then if you don't have these supporting documents, it's not possible for the auditor to say your accounts are true because there's no difference between you just sitting and inputting figures in a haphazard manner from your head, but there's no proof that you actually bought something for this figure to be here. So it's very important for track records. So this is the cash book. And then the next we can keep for a small business is a balance sheet. You can do a very simplified balance sheet for your business. You include the fixed assets. Here, when I spoke of notes earlier, this is what I meant by note. This note is just, for example, this one, you go down at the bottom of your table, you can give an explanation, say, okay, these fixed assets is made up of one office table, but on this date for this amount, computer equipment of this on this amount. So it's just for you to give more details on what is inside the line item fixed assets. This is what we call notes, explanatory notes to your financial statements. And here you can also prepare the financial statements. We say financial statements have to be comparative. So you have to be able to compare the financial statement from year to year. You can also do it month to month if you wish, but you have to be able to compare the same item last year and this year. That's why we have a year. Year N is this current year, and year N minus 1 is last year. So for example, fixed assets, you have the amount that you have as your book value for fixed assets this year as compared to the amount you had as fixed assets for last year on the same line. So you have that from your financial statements of last year. So we do the same thing for stocks. If you bought stocks, or if you paid advances to suppliers, note that advances to suppliers are your assets, not your liabilities. It's an asset if you understand it in a normal sense. You have given money to somebody, but you have not yet received the service. So the money is still yours because you have not received the service, so you can ask for the money back. That is why it is an asset. So we have customers, that's what our customers owe us. Sundry debtors, what others owe us for not customers. We have cash in hand, what you have in maybe your Momo, if your business uses Momo for its accounting, or what you have as cash as in your cash seal in your office. And we also have cash at bank for your bank statements. So you actually have to, if you have a bank account, you have to get your bank statements and verify and ensure that the amount here is the same as the amount on your bank statement as at the date that you're preparing your financial statements. So we move forward to the right where we have the sole proprietor's accounts, where you put the data that you've contributed as a sole proprietor. If there are many of you, then you have to put maybe shareholders account instead of sole proprietor. You put shareholders accounts. And if it is a business where you have paid part of the capital and part remains unpaid, you're going to have two lines. You're going to have a line for capital called up and paid, and you have a line for capital called up and unpaid. So you don't mix those two, so that it is clear on the face of your financial statement that there's capital that was called but has not yet been paid. What we talk about called and unpaid is, for example, you could start a business with your friends. You say, this business we want to start with 10 million, but we say that, okay, for now we need 5 million to start, so everybody should bring 5 million. Everybody should bring their 5, everybody should bring 1 million. So your called up capital is 5. That's called up if, for example, some people have paid inside the 5, some people have paid and some have not paid. Some people have paid, makes it 3 million has paid. So on the line here, you have called up and paid is 3 million. You have a line for called and unpaid, which is 2 million. So the 3 plus 2 pick up your company capital. And then you can have a line for your net income or loss for the period. This comes from your income statements. This should naturally come from your income statement. It's true you can get this by summing your assets and subtracting your liabilities, but to ensure that your income statement is correct, this figure should naturally balance this sheet. So you can also have loans that you've taken from the bank or from other persons. You have suppliers, that's the amount that you still have to owe your suppliers. Sundry creditors, the amount you still have to owe others. Okay, the next sample financial statement will be the profit or loss. Let me try to expand it. To zoom out a bit. Okay. Things all cannot be displayed at once. I'll do it. So the headings are the same. You should note that here where we have the name, normally your profit or loss is period, is not as at as your balance sheet. Your balance sheet gives you the situation of your business as at one particular point, which is maybe the end of a period, a financial year. But then your profit or loss statement, it gives you the results for a particular period. That is it is not cumulative as is your balance sheet. What is your balance sheet is as at. It means that you are as at 31st of December, say 2021, what you have as an amount on your balance sheet for the line item, say fixed assets. If you started your business 5 years ago, it is the value of your business since 5 years to today. That's as at today. That's why we have balance sheet. Your balance sheet statement, normally balance sheet of this at today is at a particular position. That's why we call it a statement of financial position. And then we call your income statement the statement of financial performance, because this is your performance for 1 year only. It's not for 2 years. You could have comparative for this year and last year. That means year end minus 1 is what happened just last year, and year end is what happened just this year. It is not a accumulation of what happened last year and this year. No, it's what happened in this year individually. This is contrary to your balance sheet, which is accumulative. So we should take note of that. That's why the heading is the period ended instead of as in your balance sheet. So for your income statements, your P&L statements, you can have a line for receipts from sales. If you're selling goods or you're renting services, you put it there. And you can also have notes. If you have explanatory notes to give, you also put numbers there and you explain at the bottom of the financial statements. So you can have other receipts from activities. This gives you your total income. And then you go down, you list your expenses, because normally your income statement is supposed to show your total income, your total expenses, and then the profit that you have from there. So you go down, you have the expenses on purchases, what you spend to buy stuff, what you spend on rent, salaries, taxes, interest, and other expenditures. So it's just like a summary of what you have on your cash book, but with more, because your cash book does not show things like depreciation. So you have total expenses for your business, and then you have now the balance. That's the difference between you compare your income and your expenses. If your income is more than your expenses, it is a surplus. And if your income is less than your expenses, you have a shortage. And then you do your variation of stock. If you have stocks, if you have receivables from last year and this year and operating debts, so you do variation. The variation is the difference between, that's the change in an item. For example, if you had the stock of items for your business last year were 20,000 francs. This year, you have the stock of items of 25,000 francs. It means that you have more items that are stocked up in inventory, more cash that is stocked up in inventory. So the change is going to be negative. Negative because if your items are in inventory, means that's your cash that is in your inventory. You have never received money for that. So if your change between last year and this year when it comes to assets is more, that means what you have in your assets this year is more than what you have. Well, we talk of assets, I'm talking of current assets only. Or current assets like stocks, receivables, sundry receivables. If it's more than what you had last year, it means that many people owe you, or you have your cash tied down in inventory, which is not good for your business. That's why it's a negative impact to your business. It's the opposite. If, for example, your payables for last year are less than the payables for this year. It means that you have withheld cash that you were supposed to pay suppliers. So maybe you use the cash for something else. So it is actually good for your business, as long as you have not exceeded the payment terms for the suppliers that they might not be able to supply you in future because you defaulted. So always make sure that you do not default. You can hold back, but don't default on on the deadline that your suppliers give you. So you do the variations for these items and you have your net variation. And then you have amortization if you have intangible assets, and then depreciation if you have tangible fixed assets, and provisions for items like stock, receivables. We'll do provisions for those in case they get bad, provision for bad debts. Maybe you sold something to a customer and their business is really not doing well, they're liquidating, so it's really a bad debt, so you do a provision for it. Maybe somebody is not able to pay back, you do a provision for it. But then if you bought assets, you have to be able to, if you bought a machine, the general tax code provides rates per item of fixed assets. So you have to be able to use the exact rate for the item that you've bought per the rates that are provided for in the tax code. So a machine has a different tax rate of depreciation as compared to an office chair or the AC. So they have different rates. So ensure that you have a fixed assets register if you have fixed assets, even if it's just one. The line item should have just, if your asset is just a computer, put create an Excel sheet. You call your fixed assets register. You put the date of acquisition, the date you bought the item, you put a description, you put the cost of the item that you bought, and then you put the depreciation rate per the tax code. You refer to your tax code and get the depreciation rate for that particular item, and then you depreciate it. So you can actually compute the depreciation for that item. So you should not wait for a long period of time. Say, no, I want to apply maybe 5 items before I start depreciating. No, and always ensure that you have supporting documents for your fixed assets. It's very important. Okay. All right. So this is it. And then we have the total depreciation. So at the end of your income statement, you have a net income for the period. So your net income will be the balance of surplus or shortage you had up here at C, where you have C, you subtract your net variation, and you subtract your depreciation and your provisions. So you know whether you have a net income or a net loss for the period. Okay. Excuse me. All right, so. Right, thank you very much. We've come to the end of our presentation. Let me check in the chat if we have questions.